Hello everyone, welcome back to our channel. Today we are going to discuss and understand how businesses, let them be big or small, actually get the money they need to either start, run or grow. This is a very crucial question, okay? Because as they say, finance is the lifeblood of industry. Do you agree with that? Finance is the lifeblood of industry, right? So today we are going to dive deep into the sources of finance. First, let's talk about why businesses need money or capital. Okay, now capital, what is capital? Capital means money needed to start, run or grow the business. That is called capital. Okay, and why do they need it? Primarily for two reasons. One, to acquire fixed assets. Two, to meet day-to-day expenses. These are the two major reasons. Okay, one, to buy long-term assets like say land, building, machinery, etc. And this is called fixed capital. And this is the foundation needed to produce goods and services. Fixed capital generally is needed to produce goods and services like machinery, land, okay, buildings, etc. And the second one, working capital. This is basically the capital needed for day-to-day operational cost. Okay, the money which is needed for daily recurring expenses or day-to-day operational cost is called working capital. Like say for example, buying raw materials, paying salaries or wages, managing inventory, etc. Okay, now this keeps the business running very smoothly. Okay, now let's also try to understand where does this capital come from. Before that, let's try to classify the type of finance. Okay, now broadly we can classify them based on the repayment method. Generally, logically, any finance, any capital is classified based on the repayment method. If the repayment period is long, it is called long-term finance. If the repayment period is short, it is called short-term finance. Very good. Okay, and long-term finance basically is the money which is needed for big investment. Okay, usually say for example to buy a land, to buy a machinery worth crores or lakhs. Okay, at that time long-term finance is needed, and it is usually repaid over many years. Repayment could be for say 10 years, 15 years, 20 years. Okay, that is long-term finance. Short-term finance, this is needed to cover your immediate needs like your working capital. So to pay the salary or to pay the wages, you take the finance and you repay it in a shorter period, in 6 months, 1 year or 2 year. It is just short time. The repayment is just 1 year or 2 year. It is called short-term finance. Okay, and generally short-term finance is needed for working capital for our day-to-day operations. If you are buying a land or big asset, you will not take short-term finance. You will always take long-term finance. For small things, for short-term things, okay, for daily operations, you take short-term finance. Okay, now let's try to understand the sources. Where does long-term finance come from? A major source is issuing shares. What does shares mean? You people might have heard about the share market, the shares, right? Now, what does shares mean? It's a part ownership of the company. Very good. Okay, the company sell their ownership stakes. That is what shares is, and that is the major source of long-term capital requirement, fulfillment of long-term capital requirement these days. Okay, and there are generally two types of shares: equity share and preference share. Equity shares they represent basic ownership. It's a basic ownership. Normally when you become a partner in some company, the basic requirement, basic ownership, that is what equity shares is. You get a voting right like the owner, and dividends if profits are high. If the profits are high, you get higher dividend. Okay, but one loophole, one weakness in this is, one disadvantage is, if the company winds up means if the company closes, then equity shareholders will be the last guys to be paid. They are only paid after everyone is paid, because you are the owner, you are the part owner. Your amount, your shares money will be paid only after everyone else's payment is made, the creditors, the debenture holders, everyone. After that, if money is remained, only then you will get paid, otherwise you won't get paid. Okay, they carry more risk, but they have a potential for higher returns. The dividends which you get in equity share, if the company is doing good profits, you get higher dividends. The second one is preferential shares. Now preferential shares, they are offered preferential treatment. They are generally given a fixed dividend. They don't take part in the higher dividend. Sorry. Okay, they are generally paid a fixed dividend, and they are paid before equity shareholders. Okay, so their dividend is paid before equity shareholders. Okay, and when the company is closing, if the company is getting wind up, then they are paid before the equity shareholders. Okay, they have a priority in repayment if the company closes as well. Understood? Okay, that is equity shares and preference shares. Now another key source is debentures. How many of you have heard of the word debentures? Very good. Now these are like loans taken from either the public or the institution. It is like, debenture is like a promissory note. The company promises to pay back the loan with a fixed interest rate. That is what debenture is. And the holders, debenture holders, are creditors. They are not owners. The difference between equity shareholders and debenture holders will be, debenture holders will be creditors. Okay, they generally get a bond, like a promissory note. They get a bond where it will be written that, okay, the company is taking this much money from you, and they will pay you after so many years and with this much interest. Okay, so they are the creditors, not the owners of the company. Okay, and generally they get paid before shareholders. For example, if the company closes, okay, debenture holders get paid before any of the shareholders, even equity or preferential, anyone. Before them, debenture holders have to be paid fully. Only if there is money remaining, then it will be going to shareholders. And generally debentures are loans secured against the company's assets. Okay, it's a sort of mortgage as well. Okay, generally they do it that way. Excuse me, sorry again. Okay, now companies generally, they can also fund themselves. There is something called internal funding or self-financing. What that means is, so instead of, generally when they are making good profits, when companies are making good profits, instead of distributing all profits as dividends to all shareholders, a portion is always reinvested back into the business or retained. You remember the reserves in accounting class? Very good. This is what it is. Okay, out of the profits, okay, the company keeps some amount as reserve for growth or modernization. That is basically called ploughing back profits. Okay, and this basically strengthens the financial position of the company. Okay, now finally, for long-term needs, okay, business also turn to big financial institutions, specified financial institutions. In India, we have institutions like IFCI, which was established in 1948. Then also we have SFI, State Financial Corporation, sorry, SFC, and the IDBI as well. Okay, now IDBI today it is converted also into bank. Same is the case with ICICI. Very less people know that IDBI and ICICI actually are the institutions who actually give loans to big companies, long-term investments, long-term loans to big companies. And ICICI also plays a very crucial role for the private sector. Okay, so these are also the source of long-term finance. Okay, if you are looking for long-term finance and very big amount, crores of rupees, if you remember, for say our metro station, to build metro, if they want to get a loan, okay, if they want to get a loan to build metro, L&T, for example, L&T has built the metro for Hyderabad. Now if they need a loan, they go to banks like ICICI, IDBI or IFCI. They don't go to small banks or commercial banks. These are industrial banks. These are big Indian institutions. Understood? Okay. Now, this is about the long-term finances. Now, where do we get the short-term finances from? Yeah? What is a short-term finance firstly? What is the meaning of short-term finance? For working capital, for day-to-day needs, money needed for day-to-day needs or for working capital is called short-term capital. Now, what are the sources to get short-term finance? Commercial banks are the most common source. Commercial banks, when I say commercial banks, banks like Punjab National Bank, SBI, SBH is not there now, okay, or these small banks, okay, all these banks, all these commercial banks, they are the most common source. And as for working capital, they provide different products. They can provide, say, loans, okay, short-term loans. So it will be like 6 months loan, 1 year loan or 2 year loans, okay. These are loans. They are repaid over a short period in installment. Then they also provide cash credits. Cash credit is against a guarantee. They will give you a cash credit. Okay, they allow borrowing up to a certain limit. They give you a limit against the guarantee. That is cash credit. Overdraft. Overdraft is used almost by all businessmen. Okay, what does overdraft means? Do you have an idea what does overdraft mean? Okay, OD means the bank basically gives you an extra amount of limit. Even if your bank balance is zero, you can utilize bank's money to an limit. That limit, the permission to withdraw more money from a current account than it is available, okay, to a agreed limit is called overdraft. And this is also for very short period. And in overdraft, what happens is, for example, you did an overdraft of say 50,000 or 1 lakh and you repay it within 3 days, you only pay the interest of 3 days. Whereas in another loans, you have to pay monthly interest. Here overdrafts will be daily basis. Okay, you have to pay interest on a day basis. You used it only for 17 days, you pay only 17 days interest. Okay, you don't pay it daily, but it is calculated on a daily basis. Okay, next, discounting bills. Now, bills are, in the accounts we will have bills of exchange, bills receivables, bills payables. In accounts we have it, but here let's understand. Okay, bills, for example, post dated checks are there or bills are there. You have them but you need money. So what we do is we provide these things to the bank. Based on that, based on the bills receivable, okay, the bank will give loan. Okay, or also discounting bills. Discounting bills means bank provides cash immediately against bills receivable from customers. For example, your customers are big guys, okay, or small guys, whatever. If you have total debtors of say 3 lakhs, 5 lakh rupees, and if you want a loan, against these debtors, the bank will give you loan, small loan, but they charge a small fee on that. That is discounting bills. Okay, these are source of short term and medium term finance. Now, apart from this, okay, apart from these four sources, okay, short term sources also include things like public deposits or indigenous bankers. Indigenous bankers means private money lenders. But you know, it is in common knowledge that private money lenders generally charge very high interest. Right? Private money lenders charge very high interest. Then there is also trade credit. Trade credit means time given by suppliers to pay. For example, if you are doing business, so if you want and say you are doing a business of say some product X, and the manufacturer actually sends you the product, he gives you some time to pay, 15 days, 30 days or 1 month or 2 months. That is called trade credit. That's also short term finance. That is the credit given by the supplier to you. Okay, so that is also short term finance. And then advance from customers. You understood that, okay? Some customers, they pay you advance. That is also a short term source. Okay, now apart from this long term capital and short term capital, okay, there is one more important concept which is called capitalization. Now, capitalization means it refers to the long term fund raised by a company and the plan for raising them. Okay, capitalization means, very good, capitalization refers to the total long term funds raised by the company and the plan for raising them. So the total funds which are already been raised by the company and the plan for raising this capital, this is called capitalization. And this can be based on either the expected profit or rate of return, also can be based on the cost to establish a unit of business and to run it. Okay, capitalization. Capitalization is the total capital, the complete capital which you have already raised and which you are planning to raise is called total capital, is called capitalization. Now, in capitalization, there are certain issues. For example, okay, I am running a business, and if I start taking money, more and more money, that will be actually called overcapitalization. Okay, the other problem will be I need more but I am not taking loans. That would be undercapitalization. Overcapitalization means when the company raises more capital than its earning can justify. It is called overcapitalization. And if overcapitalization is done, what will be the problem? Low dividends. Share price will fall. Right, very good. This is very dangerous. Okay, if for example my company only needs 1 crore, but from the market instead of 1 crore I have raised 2 crores. Okay, so it will be overcapitalization. So this will lead to low dividend rates and falling share prices, poor credit rating as well. And this will also be difficult to raise more funds if I need more. Okay, that is the problem with overcapitalization. Undercapitalization means insufficient funds for needs, not just like that, for needs only, is called undercapitalization. Okay, if they doesn't have enough funds to operate efficiently or even to meet their needs, it is called undercapitalization. And undercapitalization, what is the problem with undercapitalization? There will be a problem of growth. the company will not grow more. There will be difficult relationship with suppliers, strained relationship with suppliers. Most of the time this will also lead to failure of complete business. Okay, now overcapitalization generally is more dangerous because generally normal human beings, psychologically what we do is, if we are receiving more money, we take it, we just keep it, we forget that we also have to pay interest for that money as well. Okay, so overcapitalization generally is more dangerous than undercapitalization. Right? Now, understanding the right amount and the right source of finance is very critical for any business. Okay, so they need to understand how much capital is needed and what is the source. Should they go for long term or short term? If they are going from long term, from where they take? If they are going from short term, from where they take? All these are very critical and very crucial for a business to survive. Now, from issuing shares and debentures for long term growth and to work to managing this one working capital, either with bank facilities or others. Okay, choosing the appropriate source is always the key for a businessman, for a business to run smoothly, effectively and successfully. Okay, the first thing is they need to find how much capital is needed. Second major thing is finding the appropriate source, choosing the appropriate source. Okay, that is the key to success. Now I hope that this breakdown of sources of finance was very helpful, and if you learn more, give this video a thumbs up, subscribe for more business insights, and let me know in the comments if you have any questions. Okay, thank you for watching.